Thank you, Amy, and welcome everyone to today's session of the 41st Annual Eide Bailly Bank Seminar. At this time, I would like to recognize our partners and associates of Eide Bailly who support this event. Thank you all for the service you provide to our firm and to our clients. Thank you all for attending this virtual event today. My name is Gary Smith, and I'm the partner in charge of the Financial Institution Service Group at Eide Bailly, and I'm excited to be your host today. Our motto for this year is community, and we recognize how community banks have brought unity back to their communities as evidenced by your unwavering commitment to the success of the businesses and individuals in the communities you serve. Your contribution to a bright financial future in your local and regional economy is recognized and it's respected. We are honored to have you join us today. We have a great program for you today, and which is eligible for up to 2.5 hours of CPE. Today, the Eide Bailly Bank Seminar has turned from an in-person live event to a 100% virtual format through November. In our first hour, we'll hear from Don Musso, President and founder of FinPro Inc. and FinPro Capital Advisors. And we'll have our popular M&A panel with up to 90 minutes scheduled to accommodate questions from our audience. We appreciate your attendance and hope you join us for our final event on this Thursday, November 18th, starting at 2 p.m. Central. Again, go to eidebailly.com/bank seminar 2021 to register. Before we get to our keynote, I would like to extend a special thank you to Cheryl Knutson and Amy DeGeorge, who've spent considerable amount of time planning and organizing this event. Thank you, Amy, and thank you, Cheryl. I'm honored to introduce our keynote speaker to kick us off today at the Eide Bailly Bank Seminar, Don Musso. Don founded FinPro Inc. in 1987. He is a frequent speaker at various trade association functions and teaches at the Stonier Graduate School of Banking and the Graduate School of Banking at Colorado, along with its affiliates and Executive Development Institute for Community Bankers. He has authored numerous articles and papers on community banking and is frequently quoted in various banking publications. Don is often at the forefront of challenging banking policy. He is a founder of De Novo Banks and a significant investor in many community banks, and he has served in the board, managerial, and advisory roles for all types of financial institutions. Don, over to you to get us started today.
Well, thank you very much, Gary. I really appreciate the opportunity to speak at the Eide Bailly Conference. And I thank you guys for what you do for the industry in terms of both participation and providing education. I like to start these presentations by asking for everybody's patience. I'm an equal opportunity offender. I'd like to tell people I don't like independents. I don't like Democrats. I don't like Republicans. I'm from New Jersey and I pretty much don't like anybody. A lot of what I have to talk about today, it could be politically charged. I will try to keep it as mainstream as I possibly can. But as you can imagine, it's pretty difficult to do that. So with that, let's jump right into the presentation. We termed the phrase the workerless economy about a month ago, a little over a month ago now, at one of our economic forums. And one of our senior folks, Scott Martirana, basically after listening to all the economic data, kind of looked at it and said, you know, it's interesting. We've got an economy that's going pretty well, and we're doing it without any workforce, you know, and can we maintain this? How long can we hold this up? So the basic economic message we have is that inflation is not transitory. And I'm really pleased to see, we've been saying this since June. I'm really pleased to see that the Federal Reserve has finally come around on this topic and is admitting that it's not as transitory as they would have hoped. They now are changing the definition of transitory to be not 12 months anymore, but now to be up to 36 months. So yeah, if you're going to use 36 months, then inflation is transitory. If you use a normal definition of 12 months, it clearly is not. We have supply chain disruption in pretty much all sectors. We have it in food, we have it in energy, we have it in lumber, we have it in precious metals, we have it in automobiles, we have it in things like dishwashers and washers and dryers and the like. And the supply chain disruption is creating a significant decrease in supply, which is what's partly fueling the inflation that we're seeing. Add on to that we're drunken sailors when it comes to spending. So the US debt and deficit continues to surge. We saw the $1.25 trillion package for quote unquote infrastructure approved, even though only a third of that is actually going to infrastructure. And then we've got anywhere from 1.3 trillion to 3 trillion of proposed additional spending that the Democrats are trying to find their way through to see where they might get a compromise. Anyway, on top of our 28.8 current US debt, we'll break 30 trillion pretty easily in mid-2022. We definitely have staffing shortages. You hear quotes of about 10 million job openings, but what I like to do is question bankers. And so if I was asking everybody on the phone right now, tell me about your company, are you fully staffed? No hands would go up. And then if I were to say to you, how many of you have job openings that you're having real difficulty filling? Every hand would go up. And that happens irregardless of industry. So right now, the reason we call it the workerless economy, it's not that we have too much unemployment, it's that we just don't have enough people in the workforce. Offsetting that is consumer demand has been really strong, and it makes up about 2/3 of GDP, and it doesn't look like it's letting down. In fact, it looks like it's going to accelerate through December. However, offsetting it, good news, bad news, offsetting the great consumer demand is the Fed is going to start tapering to the tune of about 15 billion bucks a month. It'll take them through June to finish tapering if they maintain that pace. And I remind you all that tapering just means that we're slowing down the rate of growth. It doesn't mean that we're decreasing the debt, we're just slowing the rate of growth down. So we are going to have GDP growth, but it's going to create rising rates. And I know there were some questions on rates, and I'll get to those in a moment. I think the only thing that can derail our current economy, the strong GDP growth, and the pending rising rates in 2022 is going to be a black or green swan event, or as I like to say, stupid tax policy, which it looks to me like we're well on our way to doing. So taken all together, we call this the workerless economy. Let's go to the underlying data. This looks at the inflation since 2000. You can see in the far right-hand side the effect of COVID starting in 2020 and then really accelerating in the first quarter of 21 and continuing that in the second and third quarters. Historically, we've been within that, the red range, the red bars, inflation of 1 to 2.5%, which puts us pretty much on the Fed target going back the last 20 years. They've now targeted 2%. We currently, though, have blown through that. And as you know, last week, we got numbers that were north of 6% in terms of inflation. And remember, this is core PCE. So this doesn't include food and energy. Of course, everybody has to eat. And of course, everybody needs energy to fuel their homes and to fuel their cars and the like. So it makes perfect sense that we don't include those two things in core PCE on a chain basis. And I will tell you that in both of those areas, we're seeing higher inflation than 6%. It's across the board. We're seeing it in energy. We're seeing it in ag. We're seeing it in precious metals. We're seeing it in cotton. And when I look at this chart, a lot of this is self-inflicted. In terms of energy, closing down pipelines, stopping drilling, stopping shale, stopping fracking. Of course, that's going to decrease the amount of energy supplies. And it took us from being energy independent as a country to being energy not dependent. And, of course, we go to Saudi Arabia and say, hey, we were just kidding. Can you pump more oil? And they're not going to cooperate with us on that. So we're going to see high oil prices and high energy prices for the foreseeable future. So high, in fact, that the Biden administration has come out and told us all to expect anywhere from 30 to 50% higher energy prices this winter. But again, it's just happening in all sectors. So it's not that it's just one single sector that we're looking at. Well, I think I've pretty much covered this. When I look at what's going on in housing prices, you're really looking at a major increase in the cost of iron and steel and lumber. We believe that housing prices have created bubbles in certain regions. I'm not so sure that you're going to see it necessarily throughout the Midwest, but you're really going to see it in the low state taxes, Florida and Texas and Washington and Tennessee. And you're seeing a little bit of it in high-end markets in California, New York, New Jersey. So moving on, what's causing some of this is the flow of free money. Although we've had a steadily increasing money supply going all the way back to 1980, you can see that the acceleration in terms of the supply of money is just exaggerated, particularly when we get out to the COVID gray area on the far right between December 19th and August 21st of this year. I don't think that we can continue that. And if you go back in history, an increasing money supply is almost always a precursor to an inflationary period. My first political statement of the day, I can't help myself, is that the whole national debt, and having Congress pass new debt limits, to me is political theater. We've already spent the money. We can't undo, we can't unring that bell. I mean, if Congress is serious about doing something on the national debt, they need to shut the deficit down, and they need to come up with ways to start paying the debt down. I don't think either one of those is politically palatable. But to put the country through this, what's now up to a quarterly, it seems like, debate on the national debt seems to me to be totally fruitless. So I think the question is, how much debt can the U.S. handle? We currently are running at about 125% of GDP. We were told 10 years ago that once debt to GDP exceeded 100%, all bets came off, and that usually it slows economic growth considerably. That has not really happened in the United States. So I like to go out and look at the U.S. debt clock. I like to watch it spin like crazy. But look at some of this data. We're at $28.8 trillion in debt right now. That's $86,000 for every citizen in the United States, and it's $229,000 for each taxpayer. So I like to tell my wife, I said, between the two of us, we owe about $500 million. And, I think maybe we're going to have to pretend like it's student loans and ask for forgiveness of some sort. Not very many people are going to be able to fork over $500,000. So the rate this is going, we will break 30 trillion probably as early as February of 2022. By the way, this is a multi-party problem, right? Neither party has fiscal discipline. So the Trumpers can't look back and say that we didn't increase the U.S. debt and the deficits while he was in office. In fact, he continued what really accelerated under Obama. Why is all of this bringing us to this inflationary period? And what do we have to look forward to into 2022? Well, the first thing we got to understand is that the Federal Reserve balance sheet has all but exploded. And you can see out here on the right that we basically doubled Federal Reserve holdings since COVID has started, and it's continuing to grow. So what tapering is supposed to do is it's supposed to flatten this curve out. Whether it can do that or not remains to be seen. I don't see how we can have an ever increasing supply, decrease the demand, i.e. the buyers for that, either treasuries or mortgage-backed securities, and not have it result in rising rates. So I think rising rates is all but inevitable. And I think the tapering is going to exacerbate it. So I'm not surprised that we haven't seen a rapid rate rise yet. The Fed, has been purposely holding rates down, and I expect them to try to continue to do that. I just want to remind you that, this is going to start at 15 billion a month, starting in December. It's going to take us really through June to get down to zero, which will just then flatten the Federal Reserve holdings out. So I think whether or not they continue the tapering process is going to be a function of how quickly rates move and how much they move up in a northern direction. I'd like to stop right now and just take a quick second to remind most of you are bankers on the phone. And all this, although most of this is bad news for the consumer, for our industry, this is great news. We in the banking space want a rising rate and a steep yield curve kind of environment. It's what's going to optimize our economic positions. Most of us are asset sensitive, so we should do pretty well in a rising rate scenario. If you don't look at anything else on the economic section, pay attention to this chart. The light blue line is the 10-year treasury. The dark blue line is core PCE on a chain basis. If you look over time, you can see that the 10-year has almost always been above core inflation. If you were to just translate that to today, if we have 6.2% core PC inflation, it means the 10-year should be up north of 6%. Of course, it's nowhere near that. It's down at like 161. Why is that? Well, the Fed has been buying up all of the securities, and the Fed has been igniting its reverse repo book. And I'll show you that chart in a minute. So the Fed's done a really good job at masking kind of what's going on here. I think the fundamental question is, are we going to return to the norm where the 10-year rises above inflation, or are we in a new normal where maybe inflation will outpace the 10-year? Only time will tell. This is the game that the Federal Reserve is currently playing. You can see what they've done since the beginning of 2021. That entire growth up to $1.6 trillion is all reverse repo that they've done in 9 months. And that does not look like it's going to slow down in our lifetime. So this is the one thing that could hold rates down, at least from any kind of a major explosion. Excuse me. Meanwhile, we as consumers, we're doing our job. I mean, if you look, we've returned to pre-pandemic levels. We're buying everything that we can find on the shelves. There's just not enough on the shelves for us to find and buy. I think that's good news. What it tells us is we've got real pent-up demand. And because of the supply chain disruption, we're not going to solve that problem anytime soon, meaning that consumer should fuel GDP growth well into 2022. So here's the heart of the argument on a workerless recovery. This is continuous jobless claims going back to January of 2001. And if you look, we're right on track going back 20 years. So all of the disruption in jobless and unemployment claims that started at the beginning of COVID has been recaptured. So it is not an unemployment problem. It, in fact, is a problem with the workforce. And I'll show you those numbers in just a moment. Again, just to emphasize it, the long-term average for unemployment under Biden is now back to the long-term average. So, I think it started under Trump. I think Biden has continued it. They've done a good job at bringing the unemployed back to work. We now have 10.1 million jobs we got to fill. In my mind, this is the most telling statistic. In the year 2000, we had 159 million people in the workforce. Today, we have 153 million. That's 6 million less. If you took these exact same numbers at the start of COVID, we had 156.4 million people in the workforce. So we've lost about 3 million just because of COVID. That tells us two things. The workforce has been slowly eroding since the year 2000, and COVID has dramatically accelerated that curve. So I think there's a couple of questions that this drives for us. The first is, will the unemployment participation rate go back up? And my answer to that is not likely. I look at what's going on. First of all, we've got baby boomers that are naturally retiring, and the peak of that is going to be 21, 22, and 23. So that's going to be a natural pull out of the workforce. On top of that, we've got a significant number of early retirements going on. People that were working remote and working from home and said, hey, I kind of like this. I'm not going to go back to work. Some of that may come back. But the biggest pieces that I see is 2-income family households that have dropped to 1-income family households, primarily because they looked at COVID and said, this is not the kind of balance we want. But we also have a significant problem right now where there's a lot of working parents where both parents can't go back to work because they can't find the childcare and the daycare support that they need. The second question, is the unemployment number systemic? Absolutely. We have a skills gap that I don't know that we're going to be able to overcome quickly. I think we're going to have to do it not through the university system. We don't have 4 years. I think we're going to have to do it through apprenticeships and other things like the trades used to do. And then I think the final question, if we have so much unemployment, which I don't believe we do, why can't businesses find workers? Well, we can't find workers because they're not in the workforce. And so those few that are, we're all going to be fighting over, which means wages are going to go up. And it means we're going to continue to see massive resignations like we saw last month, 4.4 million resignations in the month alone. I mean, that's just unheard of. But I think we're going to continue to see that kind of craziness. If you look at this chart, I think what's kind of compelling about this chart is we started to have a nice recovery in consumer confidence after COVID. And then all of a sudden we got hit with the Delta variant and what I call the season of Biden blunders all summer long, which goes from the withdrawal of Afghanistan to inflation to you name it. He didn't have a good summer. And that has created another cliff in consumer confidence. So I want you to think about this. You would think with these consumer confidence and sentiment numbers, we would see a slowdown in consumer spending. And yet we're not. We're seeing an acceleration of spending. Why is that? Well, people are convinced that under inflation, it's going to be much more expensive to buy it next year. So buy it now. Secondly, they're saying, I've got to put my order for things in now because it's going to take me anywhere from 60 to 120 days to get my goods through the system. So very bona fide reasons that we're seeing, even though consumer confidence has plummeted. I think that will hit us in late 2022. So, I go to a lot of meetings with the Federal Reserve, and I was at one recently in Kansas City, and somebody mentioned stagflation. And so I went and I looked up the definition of stagflation. And for us to have stagflation, you have to have falling economic growth, rising inflation, and rising unemployment. Well, we don't have falling economic growth. We've got strong GDP. We do have rising inflation, but we don't have rising or high unemployment. Therefore, by pure definition, we really aren't going to have stagflation. That doesn't mean that we won't have some form of hyperinflation in some particular sectors, but I don't see Jimmy Carter-esque kind of rates returning in 2022. I do think we could see rate rises all the way back up to 5 to 7%. And by the way, it was only in late 2018, early 2019 that the 10-year rate was up in the 3.5% range. So we're going to look at a return to the 10-year at 3.5%. We're going to go, oh my gosh, this is an explosion in the Treasury. But really, that's just returning to where it was about a year before the pandemic hit. So let's take a quick look at the political environment. I like to say that a divided Congress is the best thing. And in my world, if we had nothing but complete gridlock, I'd be the happiest guy on the planet, because it doesn't matter who's in charge; they find a way to screw it up. So I say, okay, right now we don't really have a divided House, but pay attention to the Supreme Court. There are a bunch of social decisions, but there's a bunch of business decisions that are in front of the court, this docket as well. And I think as goes those decisions, so also may go the broader economy, particularly with things like, can we universally fire anybody who didn't get vaccinated for COVID? Can we prevent unvaccinated people from getting on airplanes, from going into stores, from doing stuff like that? I mean, that will have a major league negative impact on economically what's going on. Okay, because these are all hot button items, I'm not going to go through them all. I just want to bring them all to your attention. If we're not having enough fun, we're going to have to deal with tax policy, the continued threat of eliminating the filibuster and packing the courts and get rid of the Electoral College. We got a foreign policy disaster on our hands. We have everybody knows about the problems down at the border. I think the law enforcement thing may have been put behind us in the last election. Pretty much everybody voted to refund the police, but we still have sanctuary cities and states and the like. I'm only going to focus on tax policy. And again, this is what was in the purported $1.8 trillion House bill. It is still open. There are no decisions on any of these, but I'm just going to kind of give you what we're hearing in Washington and what we're seeing at our banking clients across the United States. I think everybody expects some form of a corporate tax increase. Whether it gets to 26.5% is probably dubious. Mansions at 25%. So I think we can get to 25% with just Democratic votes. I think, therefore, it's highly likely we see an increase in the corporate tax rate. We will see a surtax on incomes. I'm not sure it's 5 million anymore as the floor. It might be 25 million. That's jumping up. It's jumping down. But I think it's pretty likely that we're going to see that. We definitely are going to see a raise in the top tier personal rates. And that was probably going to be pretty hard to defend against. I think the least that you guys all could do in the Midwestern part of the country is put the SALT deduction back in for us East Coasters. Just because we have high real estate taxes, high state income taxes, isn't a reason to punish us. I mean, come on, you guys should be nice and pay our tax bills for us. Fortunately for you, I don't see the SALT deduction being put back in. I think there's going to be a huge diplomacy push on it to make it look like everybody's fighting for it, but they can't afford to have this revenue loss in the bill. They're going to pull it out. The ones I'm most concerned about are the capital gains increase from 20 to 25. As we learned when we did the Trump tax cuts, it benefited the market. The market went up dramatically. I think we can expect just the opposite to happen if we take capital gains and dividend taxes up from where they are. More importantly, I can't for the life of me figure out how we would handle taxing appreciable gains that haven't been realized. We should learn at what Elon Musk just went through. The minute he said he was going to have to liquidate, or he wanted to liquidate, a few trillion of his Tesla stock, Tesla took a huge hit. It went down 15 to 20%. Most people that I know, even the wealthy, are going to have to sell assets to be able to get the cash to pay stock. So we better hope that that one doesn't go through, or that one will stop the economy just dead in its tracks. I'm not worried about the estate tax exemption. Most wealthy people have already factored that in and done what they needed to do. Last political comment again, just to stir the pot a little bit. You would have thought after Tuesday's election, particularly here in New Jersey, where Republicans are never within 20 points of the Democrats they're running against. And in our governor race, Citarelli, the Republican, nearly beat Murphy, the Democrat. He came within a couple of points, which is just unheard of. So the message is being sent, I think, by voters. I'm just not sure that Washington is capable of listening. And that really goes to regulation as well. What's going to happen? Well, we've got a return of consumer activist regulation. It's Obama Redux. All of the agency heads that have been put in place are consumer oriented. They're not what I'll call bank friendly, not saying that's good, not saying it's bad. I'm just saying that's the reality. So we're going to have to deal with it. It means we're going to have a lot more folks that are going to get in trouble for AML and fair lending and BSA and all that kind of stuff again. I'm a little bit perturbed at what I see, what I call the Warren Doctrine, which is this general disparagement of banks. Doesn't matter whether you're a big bank, doesn't matter whether you're a small bank. She just doesn't like us, and she does everything she can to disparage us. And I think by and large, that's become a Democrat mantra. We will see a CRA rework. I'm not optimistic that it's going to make any sense at all. It cannot have a geographic component to it anymore, and they keep trying to make it a geographic play, and it's just not going to work in today's non-geographic world. You know we're in trouble when the CFPB starts hiring lawyers, and they're hiring a lot of lawyers. That means they're gearing up for a lot of activity. So, I think Rohit Chopra has made it pretty crystal clear that what kind of areas he's going to go after. So I think we just need to be prepared for that. I'm really troubled by the new proposed comptroller of the currency, Soleil Amarova. She's basically come out and said that she doesn't believe banks should take deposits. That should go to the Federal Reserve. She's also come out, many of you saw late last week, and said any fossil fuel companies in the United States ought to go through bankruptcy so that the federal government can take them over. And that will solve inflation because we can have federal pricing. Yeah, brilliant. I do expect appointments to the Federal Reserve. I thought we would see them this week. We might still, but I do expect appointments to be made before the Thanksgiving break. My odds right now are that Lael Brainerd will be named as the chairwoman of the Federal Reserve Bank. So I think we can expect pretty dramatic changes there as well. So I'm not going to spend time on Soleil Amarova. I would just say, if she is confirmed, I doubt that the OCC will have anybody left to regulate, because any OCC bank on the phone, if you stay as an OCC regulated shop and subject yourself to this comptroller of the currency, you deserve what you're going to get. So we have about 400 clients across the country. Probably about 80 of them are national banks. Probably 2/3 of those have already talked to us about what is it going to take for us to flip our charter. So it's going to be massive and it's going to be quick. We do a lot of work in Washington. We do this thing with the regulatory feedback initiative. After every exam, you fill in a questionnaire as a banker, you send it to your state association. But ultimately, it makes its way to us on a no-name basis, and we compile nationwide statistics. Each one of these bubbles is a risk area that the federal agencies are looking at. The far right means it's a hot topic right now. The far left means it's ice cold. And this is how it has moved just literally in the last 2 quarters. We're seeing dramatic movement. Notice how quickly cyber, fair lending, corporate governance, and compliance move to the right. Notice also that asset quality continues to be a hot topic for the regulators, which to me is mind-boggling. We've got the best asset quality as an industry we've ever had, but they keep telling us, well, it's been masked. It's been masked by not allowing foreclosures, and it's been masked by the amount of money we've given to companies with PPP and things like that. And I said to some of the folks in Washington the other day, if what you're saying is true, we would have already started to see delinquencies going up. We would have seen some trend, and yet we're not seeing anything that would lead us to believe that we have an imminent asset quality problem. So I think on that one, they're probably misguided. Our issue as an industry with regulators is pretty deep. I would tell you that it's pretty much across the board, House Democrats and Senate Democrats. But we have issues with some of the Republicans in the Senate and House Finance committees as well. So right now, the folks that were our biggest allies, I think, were Shelby and Senator Toomey out of Pennsylvania. Senator Toomey actually started a de novo bank in Pennsylvania, so he understood community banks pretty well. But both of those guys are leaving, and I'm just not sure that we've got a real advocate in Washington on either the House or Senate Finance Committee. So it's something that we should lose some sleep over. Demographics are always a lot of fun. As you know, I don't think we need to talk about millennials. We all know that they are now the force to be reckoned with. For most of us older folks, I'll put myself in that category, we don't really understand millennials. They don't think like us. They don't act like us. And I was joking with my son the other day. I can remember looking at my dad and saying he didn't know what the hell he was talking about. He must have lost it. And I think my son's now doing the same thing with me. Generation, we just don't get the next generation coming along. But we're seeing a major changing home life. We're seeing a lot more people that want to find that balance, if there is such a thing. Women now dominate the labor force, and they dominate universities, 60% to 40% against male. We've got real immigration issues going on. Now, it's interesting, if we're going to have this significant shortage in workers, we kind of need immigrants to fill some of that. So we've got to figure out how to make immigration legal, and how we can track it, and how we can make it somehow good for the United States instead of this political football that it's become. We're absolutely seeing a migration. You're not seeing it as dramatic as we are, but anybody who's got any wealth whatsoever has left New York and New Jersey and gone to either Tennessee, Texas, or Florida to get the zero state income tax rate. We talked about boomers' retirement. And I think the other thing we've got to understand is, for 20 years, we talked about the exodus of the suburbs and the rural areas to the cities. Young people would leave and didn't come back, and empty nesters would sell their homes in rural areas and move to the cities to avail themselves of the nightlife. Under COVID, that changed dramatically. And I think the fundamental question is that a long-term deal, or is it a temporary deal? You can look at your state to determine whether or not you are a winning state or a losing state. The winning states have the best tax situations. The losing states, have not only the worst tax situations, but there's just no jobs. You look at West Virginia, Mississippi, there's just no jobs. And then you look at the gray, and we really are going to be the telltale sign of how the economy goes through 2022. I don't know that I want to spend more time on immigration. I do want to spend a little bit of time on ESG, however. So environment, social, and governance. Of these, governance is, as you saw, remember that risk bubble went hard to the right from a regulatory risk perspective. So governance is something that they're all over. The social look is really being now pushed hard by investors more than it is by the regulatory side of the house. And the environment really can be encapsulated with climate policy and climate change. And I think there I'll issue a couple warnings in a few slides. So we recommend everybody go through a governance review. particularly before your next exam. In the most recent exams that were finished by June of 2021 that we're now getting reports on, a material increase in the number of matters requiring attention, matters requiring immediate attention, and matters requiring board attention from a corporate governance perspective. From a diversity standpoint, I look at this and I say, well, it makes sense. I mean, we want to have a diverse board. We want to have a diverse senior management team. I'm not sure we should be forcing it, however, and I think that's kind of what we're seeing happen. What I will tell you is my biggest concern for a community bank is that you don't move quick enough in diversity, and somebody in social media, an activist in social media, picks up on it, and they start a social media campaign where they start picketing out in front of your branches, saying that you guys are not diverse, and everybody should pull their money and run, pull their loans and run. And if you remember back to Jimmy Stewart, It's a Wonderful Life, where you had that big line, everybody wanted to pull their cash out. I think we could experience a social media experience like that in 2022 based on diversity. The climate risk thing is evolving as we speak. I will tell you, I'm very concerned about another Operation Choke Point. I'm worried about it with Second Amendment, gun companies and manufacturers and distributors and ranges. I'm worried about it with fossil fuel, everything from oil to propane to fracking to shale. And I could go on, but we're seeing a lot of push for the potential comptroller of the currency to come out and say she would like to see fossil fuel companies bankrupted. I mean, I think that's pretty telling. So I think we are going to see climate risk become mainstream in 2022, and I think we're going to have to really prepare ourselves for that. And it's bigger than you think it is. It's not just putting LED lights in our buildings and going to battery operated vehicles. It's really going to be, they're going to expect us to be the climate police. They're going to want us to look at all of our lending relationships and say, what are they doing to manage climate risk? So not unlike what they did with BSA, where they tried to make us the nationwide BSA police. I think the same thing's going to happen with climate risk. I would ask you not to do too much now. Wait until this thing evolves mid to 2022 or so. Technology standpoint, what do we need to know? Cyber, and cyber, right? Again, at that Kansas City Fed session that I was at, one of the analysts predicted 70% of all banks would experience a cybersecurity event in 2022. The data is telling us that we've seen a 600% increase in cyber crime since the beginning of the pandemic. 300 million people have been impacted, and 3/4 of all IT security professionals believe that we're going to have a successful cyber attack almost immediately. The other things that I think besides cyber tech is the coming of fintech. In the last 24 hours, we've had 2 deals announced. BMT Technologies is doing a reverse merger with First Sound Bank out in Seattle, Washington. Again, that's a fintech acquiring a bank. And then today we heard that Patriot National Bank is merging with American Challenger Development Corp. Same thing. It's going to be done as a reverse merger where American Challenger is really the acquirer, but they want to keep the bank charter. So it's really that you've got these fintech companies investing capital, but they're doing everything they can to keep the fintech charter. I find that interesting on 3 fronts. First, the FDIC has told us unequivocally they are not going to give FDIC insurance to fintech companies. So I think, and that's all a sea-land change from 2019. So I think that's good news for us in the banking space. We don't want them all to get charters. We want them to have to partner with us, which is the second thing that I think we got to pay attention to. And that's every fintech company is going to be looking to merge with a financial institution to get your charter. And if they can't merge with you, they're going to partner with as many as they can. They're going to look for us to invest in their technology, become owners, and then ultimately become users. The last big technology thing that we need to be aware of is the oligarchs. Jack Henry, Fiserv, and FIS are about to go to war with the cloud-based technologies, the Tenemoses and the Finexacs and the Nimbuses of the world. And all I can say, it's about time. I think it's going to be a great battle to watch. I think ultimately the oligarchs are going to have to buy some of those fintech companies out because I don't think that they can recreate themselves quick enough to be competitive. I don't have time to go through all of the cybersecurity predictions, but I just want to go through a couple. particularly this new concept called killware. And killware is where they're going in to a nuclear plant and they just literally shut the plant down. We had that happen in a pipeline, an oil pipeline in the Carolinas. And I think we're going to see more and more and more of that. I'm really worried about that in the banking space, killware that might shut down the ACH network or any of the EFT applications at all. We're going to continue to see ransomware growing. It's perceived as kind of the number one threat. Not surprisingly, we're seeing attacks on supply chains, on trucking companies, on shipping companies and the like. I think we'll probably continue to see that. And I want you to pay particular attention to number 10. As we talk about where we're going with employees and we go to more remote work, our office buildings are pretty secure. We do a really good job of securing them, but our homes are not. We're pretty vulnerable in our homes. So as we have more and more people working remote, we're going to have to dramatically increase the cybersecurity for all of our employees who are working remote and working from home. This just talks to the dramatic increase in ransomware. To pick up time, I'm going to move to number 7, which is staffing. I think we have 3 huge issues here. Remote work, which is not going to go away anytime soon. Rising compensation, that's going to be at all levels, and therefore the need for more education and training. Right now, a significant number of the resignations happening across the United States are for people who want to work remote and their companies are bringing them back to the office place. So we're going to have to figure out how to find the middle ground on remote work, but it's not going to go back to everybody goes into an office building. That will have implications on commercial real estate. That will have implications on other things, particularly whether or not the suburbs and rural markets stay strong or whether we go back to an urban market. Because we have such a worker shortage, the few workers that we can get, particularly ones that are skilled, we're going to see dramatic compensation increases. On the technology side, a great example, we're seeing people getting 30% increases in base pay to jump from company A to company B. We're also seeing a significant shortage at the entry level. Nobody can find tellers or customer service reps and the like. So, and I'm wondering, how high an hourly wage would it take for us to be able to get those people back in, and can we afford it? I think a natural evolution of the first two is that we're going to do more and more through technology, rendering more and more jobs obsolete. At the end of the day, we're going to, though, all have to be responsible for our own education and training. That's one of the things I'm really thrilled to see that Eide Bailly is doing, this kind of education and training. I think we're going to do a lot more of this stuff because at the end of the day, we're not going to find people that have the qualifications that we need for the jobs that we have. We're going to have to bring in people that are really intelligent. We're going to have to teach and train them to get them to where we want them to be. So, I think the part of this issue we're having with staffing is, as I said earlier, we've got these 2-income families that have gone to 1. We've got the retirements, early retirements, and the baby boomers. And, there's a little bit of that people were paid not to work, but, I don't think that's in the workplace anymore. I think we're beyond that. So in and of itself, getting rid of that did not solve the problem. I think that we're going to see some regional issues popping up here. So I think, depending on the market you're in, will also determine just how bad of a staffing shortage might you experience. I mean, I was out in Indiana the other day, and I was listening in Illinois, Southern Illinois, and I was listening to what John Deere is now paying hourly to some of their entry-level workers, which is north of 25. Well, are we willing to pay tellers $25 an hour? Likely not. And that means we're not going to be able to attract the top-notch entry-level talent. So just kind of a quick summary, we are going to see wage pressure. We're going to have labor competition. We're going to have huge skill gaps. We're going to have to teach people to do what we want them to do. What I found interesting is when I did that Kansas City Fed presentation, it was right after the CDC had come out with its mandate that said anybody who's unvaccinated and works for the federal government needs to be terminated, and anybody who does work, governmental work, that they're going to have to follow the same rules. And I'm thinking to myself, okay, we're 6 million workers short. We got 10 million unfilled jobs. And you're telling us that we need to fire good workers simply because they're not vaccinated? That's just stupid. And luckily, now we're starting to see states pushing back, and the appellate court just came out and basically said, no, you're not going to be able to just fire them at will. And I'm thinking to myself, thank God somebody's got an ounce of sanity. But it doesn't matter how you cut it. We're going to have this succession issue at all levels. We're going to have to figure out how and where to get the best people. Okay. I always like to, because everybody's ready to jump out a first floor window right now. But let me now give you all the great news. From a balance sheet perspective, community banks in particular are as well positioned as we've ever been. We have had pretty strong loan growth. We expect that to flatten out. It's going to be weak, but it's not going to decline. Meanwhile, we're going to continue to have deposit inflows, just not at the same pace that we've had them. If you go back to 1975, when these charts were taken from the St. Louis Fred system, we have had steady growth in deposits, steady growth in loans, little blip around 2010 in loans, but it was not a sustainable longer-term trend. I don't think we're going to see a dramatic decrease in deposits. I think the deposits we brought in are probably going to be surprisingly sticky. Meanwhile, from an asset quality perspective, look at this. Delinquencies are really at decades low. We're way down below 0.5%. Meanwhile, we've got the highest level of loan loss allowances we've had in history, and we have the highest level of tangible capital that we've ever had in history. We are so well positioned on the balance sheet to take advantage of a downturn, and we're not really getting any credit for that. And that's all on the management teams that went through the Great Recession in 2010 and have done everything they can to prevent that from happening again. I am concerned about the loan loss allowance. So, the Eide Bailly folks can talk to this better than I can. But when I look at this rapid growth in loan loss allowance because of the implementation of CECL, and then I look every quarter since then, and we've had recoveries, meaning we're bringing it back down, it tells me one of two things. Either A, we have no idea what we're doing in CECL, or B, we're manipulating the numbers to such extent because it's all based on qualitative factors. Who cares? In any event, it makes you wonder why we're spending all this time and energy to do it. I believe we are going to get regulatory pushback on this volatility. So I would encourage you to take a real hard look at the recoveries you're doing. And even though they tell us that the qualification factors don't need to be, the assumptions don't need to be proved in any way, that they're qualitative, I'm not sure I buy that. I think you're going to have to be able to justify why you have some of the qualification rates that you have. Okay. So the balance sheet, super strong. Loan demand will be weak, but it'll still be there. Loan yields are going to decline because we've lost the advantage of PPP yield adjustments. Asset quality is holding. Can it continue? Yes, I think it will. Loan loss allowance volatility has got to come to an end, and deposit surge is going to, I think, remain fairly strong. Okay, let's take a quick look at the income statement. On an ROA basis and an ROE basis, we've done a great job at recapturing the COVID loss, and most of that recapture was PPP driven. Therefore, we can expect ROA to drop and ROE to drop. And I don't think there's going to be enough growth in the balance sheet for us to earn our way out of it. So, I think the NIM, without a rate rise, I think NIMs are going to fall well into the mid twos, where it already is for some of the larger banks. And by the way, we're not the only country experiencing this. If you go to any other country outside the United States, their net interest margins are below 1.5%. So we're an anomaly here in the United States. And sometimes I think we all get so lost in what's going on in the US, we forget what's going on in the broader international picture. But net interest margins could take a big hit. If rates do what I think they're going to do, we probably can hold yield. We probably will delay rising our funding costs because we can afford to lose a little bit of it, let a little bit run out the door. So I think we can actually hold net interest margin in 22 if rates do what we project them to do. If rates stay low, net interest margin is going to free fall. Okay, you can see that here in the yield. What I find really interesting about these charts is the small banks by the brown line are way outperforming the bigger banks. And if I were to do this with a break at 25 billion bucks and above, you'd see it even more dramatic. the yield on assets at banks over 25 billion is now below 2.5%. So it's way down here. Meanwhile, we've done everything we can on the cost of funds side. I commend you as an industry. You dropped our funding costs. Most of us are now well south of 25 to 30 basis points. There's not a lot of downward room there. So our funding cost is probably stabilized. Our yield is going to come down. That's the compression that we're looking at seeing. So what can we expect from an income statement standpoint? Well, I think loan yields will decline unless we get the rate rise. Deposit rates are at bottom. As such, I think we've covered that. We're going to see a NIM south of 3, north of 2.5. So we're going to have to find fee income, and we're going to have to find a way to cut expenses. It's just that easy. Okay, I don't want to spend too much time. I know you got a whole panel in capital markets. I just want to hit a couple of key points. The first is that we are going to consolidate. We're going to continue to consolidate. We have old senior management teams. We have old boards of directors, and they're tired. They're looking at this and saying, this might be as good as it gets. So I'm going to cash out while the getting out is good. We also are seeing that push from Fintech that I mentioned earlier, and I think that's going to accelerate consolidation. We now are a little over 4,950 some odd banks left in the country. When I started, there was almost 20,000. And I think probably we'll be down around 4,500 by this time next year. I think it's going to accelerate, not slow down. We do have some uncertainty in the value multiples. I think multiples actually will increase if we have a tax raise. It would be just the opposite of what happened with the Trump tax cuts. But that's not a good thing. It just means that we're making up for weaker earnings. Right now, almost all the capital raising that we're seeing is sub-debt related. And so I think the real question is, where is this non-traditional competition going to go? How is it going to be regulated? Who's going to be regulating it? And what's it going to do? Let me just give you 2 examples. I'll start with cryptocurrency. If they don't corral cryptocurrency pretty soon, the Fed's going to lose control of the money supply, because there's going to be as much in crypto as there's going to be sitting out there in US dollars. And if the Fed doesn't control US dollars and the money supply, it doesn't control the economy or rates anymore. So then you'd say, why do we even need the Federal Reserve? So I think we are going to see a euro crypto. We're going to see a yen crypto. We're going to see a ruble crypto. And the Federal Reserve is working on a digital dollar, digital crypto as well. But I don't think it will roll out. It's almost ready, but they're not going to roll it out probably until 22 or 23, and they'll do that with some trial balloons. So we'll just have to see where that goes. So this just talks to the numbers, but because you've got a presentation, I really don't want to spend any time on it. What I think I would like to close on is where do we see this going? And if I was a banker, if I'm sitting in your shoes, what would I do? And then I'll take questions. I would plan for multiple scenarios. I think we've got probably the most likely scenario: GDP growth, continued inflation, non-transitory. We're going to see rates go up, particularly on the long end. Short rates will lag a little bit. So a rising, steepening curve. But I could see the wheels coming off the bus too. So I think we need to have a plan of what that might look like. I think to satisfy the regulatory folks who believe that asset quality issues are imminent, I think we need to stress test some of our more worrisome loans, put that issue to bed. Don't let them come in and make an issue of it. Put it to bed before they get there. We're going to have to start doing customer loyalty studies. If deposits keep flowing in and we don't have enough capital to grow into the base, we're going to have to start pushing some deposits out the door. I already have that with my Asian clients and my European clients. So we're now just following an international trend there. And I think we need to focus on liquidity risk, the opposite of what we would expect. It's having too much cash. Focus on asset quality to keep the regulators off our back. Really zero in on your earnings and what you're going to do to hold earnings as strong as you can. And then prepare yourself for green swan events or climate controls. I think we got to look at our brick and mortar networks. I'm not sure that we're going to see a ton of branches closed, but I do think we're going to see a lot of them dramatically cut hours and dramatically cut the amount of space that we're occupying as a way to trim our expenses. I think we're going to see a dramatic increase in outsourcing. We're already having it in areas like internal audit. We're already seeing it in compliance. We're already seeing it in ALCO, but I think it's going to become even more mainstream than that. And I think the regulators are preparing for that as well. And then I think we've just got to be prepared to have all of our analytics done the same way. So with that, I think, Gary, what I'd like to do is open it up for questions if there are any, and I'll be glad to respond to them.
Yeah, Don. We do have one question in here. With our balance sheets bloating due to the surge in deposits, with the prospect of even more money getting into circulation as a result of the Biden stimulus bill, how will the regulators view our capital ratios, especially the leverage ratio?
Yeah. So as you all know, under COVID, the regulators gave us a waiver period to say if you go below 8%, it's not that big of a deal. We're going to give you a little bit of forbearance on that. That now has expired. We're watching the exams that are taking place right now to figure out what they're going to do. I'm of the opinion that they are going to curtail banks that have a tight tangible capital ratio, tight common ratio. I think they're going to curtail their growth, and they're going to say, whether you can bring them in or not, we're not going to let you. So they're going to start to set growth limits on banks that have weak capital levels. By the way, weak, 8% we're calling weak. It used to be 4% was weak, right? So for crying out loud, let's go off our backs. But
Don, I know we did have some question on oil prices and just kind of the overall, we have a number of financial institutions up in the Bakken, right? And there seems like there's plenty of oil supply up there. I mean, I think we're all still thinking we're energy independent, but I know you did talk about that. Any comments regarding, why we're not independent anymore? Is it all those things that you mentioned earlier?
Yeah, it's all policy driven. It's shutting down pipelines. It's shutting down drilling. It's making shale and fracking super expensive to do. And, I get, the climate issue, and I get the need to go green, but not at the expense of every other, not letting every other country have their way at it. I mean, coming out of the COP, we saw India put back in all kinds of coal provisions, right? So they're telling us in the US we can't do coal, but every other country is going to continue to do it. So I don't know that we can become the green police of the universe. I'm hopeful that there's going to be a change of course there, but I guess I'll call it guardedly optimistic.
ESG is something we got to be looking at, right? I think there's no doubt that it's something, like you said, you need to have a plan at least to talk about it as a board and continue the discussion. So,
and Gary, I think you would agree with me. By and large, it's the right thing to do. We do need to have equal representations on our boards, and we did not. We're getting there quickly. So I think from that standpoint, it's the right thing to do. I just don't want to see it forced where we put unqualified people into positions. I think we need to have a plan, and we need to stick to that plan bank by bank by bank. But it's here to stay. It's not going away.
Well, with that, Don, I want to thank you very much on behalf of the firm and all of our clients for your presentation today. I thought you brought up a lot of really good points and things for our banks to ponder as they move into this next 12 months. It'll be interesting times for all of us, right? So
yeah, well, thank you for having me, and thank you for all that you guys do. We appreciate you.
Thank you, Don. We appreciate it. We're going to move now into our panel on M&A, and I'm going to turn it over to one of my partners, John Fisher, to get us started. John, over to you.
Well, thank you, Gary. And I want to welcome all of our participants today to the M&A panel portion of our 41st annual seminar. Here we are. Just a year ago, we held our first virtual seminar, and we thought it would be our only virtual seminar. Thought we'd be getting together back in person. Obviously, that hasn't happened, and we thought we'd be getting back to normal. I guess we don't know what maybe normal is anymore. Our format today will be very similar to what we've done in the past. We will start out with looking at sales data across the region and across the nation, and also just a general state of banking. We'll cover topics that buyers and sellers need to be aware of early on in the process of negotiating a potential deal. We will then touch base on some new negotiated terms our panel may be seeing when it comes to drafting purchase and merger agreements. And then we'll go right into the regulatory process. Also focusing on new or unique things we've seen in the last year due to the pandemic or due to the regulatory staff working remotely, just what is new out there in that area. We will then finish with some additional non-banking considerations that buyers and sellers need to be aware of as part of a potential deal. I will add that while we do have these topics, I invite any of our participants online to submit questions using the question and answer button down at the bottom. Today we do have 4 panelists with me from across the upper Midwest. The first panelist I'll introduce is Karen Grandstrand. She is a shareholder with Fredrikson and Byron in Minneapolis, Minnesota. Karen is a nationally recognized bank regulatory and M&A attorney and a financial industry advisor. She advises clients on examination matters, compliance and enforcement actions, mergers and acquisitions, the recapitalization and acquisition of troubled banks, private equity and other investments in banking organizations, corporate governance, risk management, payment system, and trust matters. Prior to joining Fredrikson and Byron, she had a 14-year career with the Federal Reserve Bank of Minneapolis, where she was initially in the law department and ultimately the senior vice president of the banking supervision and risk management departments. In this position, she was the senior officer in charge of safety and soundness, consumer, CRA, trust, and IT examinations, as well as applications involving banks and bank holding companies. Another panelist is Howard Hagen. He is with Dickinson, Mackaman, Tyler, and Hagen in Des Moines, Iowa. Howard chairs the banking law group with the firm. For over 25 years, he has counseled banks in virtually every Iowa county on such issues as regulation, acquisitions, and various corporate and shareholder matters that have confronted banks both in good and troubled times. Howard has also served as counsel to the Community Bankers of Iowa for more than 20 years. He currently serves as a member of the American Bar Association Banking Law Committee. Earlier in his career, Howard served in the public sector as Assistant Attorney General and General Counsel to the Iowa Banking Division. Our next panelist is Paul Foster. Paul is the president, senior shareholder, and founder of Paul Foster Law Firm in Norman, Oklahoma. In over 30 years of law practice, Paul has been involved in both state and national bank and holding company legal, regulatory, consumer, and commercial matters. While general counsel to the Oklahoma Bank Commissioner, Paul is active in both state and national regulatory matters, including leading the drafting of the committee for the redraft of Oklahoma Banking Code. Following his tenure with the banking department, Paul was selected to represent the Community Bankers Association of Oklahoma. Paul is currently in private practice, focusing on financial institutions, legal regulatory matters, including advising and representing banks, holding companies, bank directors, and bank owners in the formation of bank holding companies, bank capital, and recapitalization matters, mergers, acquisitions, sales, and any other financial institution, legal or regulatory matter on the state and federal level. Our final panelist is Dana Ereth. Dana is a principal with Eide Bailly in our Bismarck office and co-chairs with me the FISG M&A group. He has more than 25 years of experience providing tax and consulting services for financial institutions. Dana is a former bank regulator who applies his unique perspective of the banking industry to the tax consulting work he does with financial institutions. He helps banks plan for the future and keep in compliance. When you work with Dana, you can expect an industry professional whose insights into the banking industry make him a uniquely qualified partner who can help your institution thrive. He provides consulting services to financial institutions in the area of strategic planning, merger and acquisitions, change of control, de novo charters, branching, due diligence, loan review, asset liability review, and regulatory enforcement actions. So with that, we got 4 great panelists. I'm glad they're here to present for us today. To get started, as we've done in the past, we'll get started with the general state of banking in the M&A sector and what that looked like in the last year with the pandemic. We'll start with Dana, if you could comment on that and where things are at compared to a year ago. Dana?
You got it, John. Thank you. Not just comment on it, but show you lots of slides that are showing exactly where we're at and where we came from. Thanks everybody for joining us today. I always look forward to discussing M&A across the country and especially Midwest to the western part of the country. Gary mentioned up front our theme this year is community. And when I look at the M&A deals of the year, community is not exactly what comes to mind. I'll show you in a little bit some of the slides that really 2021 could be characterized as large banks being bought by larger banks. Record amount of deal value through October, breaking records going back to 2019. But it's really been a year of big banks doing big bank deals. And with that, a lot of the big bank deals have been stock deals. And I think if you guys were with us last year when we were doing some predictions, one of the predictions was that with prices being soft, when we did this seminar last October, we were near the bottom of the regional bank pricing. And so a lot of discussion was around when your stock's not worth much, it's probably the deals might be more geared towards merger of equals or true mergers of stock swaps. And we definitely saw that happen. So let's just jump right into this. I'm not going to spend a lot of time. There's a lot of slides, a lot of information, always a lot of information. The idea here is to let you guys kind of cruise through it at your own speed, depending on what state you're from. We've got data for most of the states that our footprint reaches. So I'm gonna cruise through this stuff pretty quick and just kind of highlight some of the things that I'm seeing. So starting with this slide, you can see we're going to go from left to right on these slides from 2012 up to through June 30th. Number of commercial banks has not dropped too much from last year. A little bit of de novo activity in there, not much. I think the significant factor here is the number of banks under 100 million. When you compare 761 as of June 30th compared to 2012, it's a pretty significant drop. We're over 61% less banks this size. But that's not all merger activity, obviously. Deposit growth has pushed a lot of banks over that 100 million that hadn't seen growth like that before. And I think that's the other thing that when you look at this slide, look at the total deposits. I mean, this is no surprise to anybody, but I think it kind of illustrates to the extent of the deposits that are in the system. Just looking at from 2019, we're up 4 million or 4 trillion in deposits in the banking system. And it took us 8 years, 7 years to go up 4 trillion before that. Some interesting comments by Don there about whether those deposits are stable deposits or we're going to see them start running back out. I think that's one of the big questions in M&A activity. I think the next slide is just going to show you, I think we had announced through October 180 deals in the country. And you can see they're concentrated. The red dots are the larger deal values of over 100 million. So that's actual premiums being paid, so to speak, on a deal. It's not asset size. It's not capital levels. It's actual deal value. You can see the extent of the concentration where we have charters, right? This isn't that surprising to see a map like this. If I draw a line from the west of the Dakotas down through Texas, all the states out west here, total charters represent about 10% of the charters in the country. So when we look at forecasting M&A activity, obviously, I think you would probably have a repeat of what we're seeing happening here, maybe catching up with some of the smaller deals, not the large ones that have dominated landscape this year. Last year when we were talking about pricing for banks, was pretty hard to judge because a lot of bankers were cleaning up their own shop, so to speak. And this shows you loan loss provisions in the past year and a half, 2 years, almost 3 years, going back to 2018. And you can see the tremendous run up and now actually some reverse provisioning we've seen in the industry in 2021. And you can see the direct correlation to the community bank index, which is a regional smaller bank index. You can see where we hit the trough about when we were having this conversation last year to where we're at now. It's over double where we bottomed at, and this index is well above what had been highs previous to this time period. So I just use this diagram really to show pricing for bank deals are going to follow pretty closely what we're seeing with the regionally traded stocks. And the regionally traded stocks have gone up because loan provisioning has dropped. Getting into some of the specifics here, again, I'm not going to spend a lot of time on this. This is just showing the number of deals that we've had. I think the thing that kind of jumps out here is, the size of the deals. I think it's probably a better slide coming up here that shows us the size of the deals. This is the pricing on it. You can see 2021, we're back up to 155 on a tangible book. So we're right in line with where we were at in 19. So the question really becomes, do we continue this trend up towards 18 levels, or are we going to hit a more moderating price going forward? Branch deals, the only thing I'm going to mention here, there's not a lot of deals to even be talking about, but there's a lot going on in the branching space. A lot of big banks that have been closing branches. So I think this actually represents an opportunity for some of our community banks to be looking at. We'll probably get into that more on the prediction side. I don't want to take too much time here because we got a pretty impressive panel to talk about a lot of stuff that's going on here. And so the rest of this stuff is really going to show you, this is going to be the deal value, deal price to book value. Nothing really jumps out other than the Southwest banks have always traded at a little bit of a premium. That would be some high earning banks and just a limited number of charters. But what really distorts 2021, there was a couple deals in Utah that went for close to 3 times book. So and they were large bank deals. So it's going to distort the overall data. Next slide. This is just a national. This is going to show the Midwest, Southwest to national. I just talked about that. Price to earnings. I'm not going to spend a lot of time on this because, again, this can really be distorted based on publicly available information compared to what we're seeing in our marketplace. It's a tool to use when you're looking at pricing deals, but for the most case, deals are still being discussed as terms of premium to book. Let's see what else we got here. So this is where we're going to get into by region. So you can drill down a little further into the Midwest. This would be the Southwest, then the West. Again, a lot of this stuff is just being provided to you as stuff that you can kind of look at depending on where you're at. This is going to be branch details. We're going to have a little bit of information here that's going to kind of piggyback on what Don was talking about. National banking summary, we're going to flip this around. Now we're going to go from most current to the past. Again, it's just kind of regurgitating a lot of information we've already talked about there. You can see the reverse provisioning happening in 2021. That's propped up a lot of banks. The return on assets back to 132. We're back to 2018 levels. Now, obviously, a lot of stuff has gone into the 132 that we're seeing as a performance ratio, PPP fee income, mortgage originations, mortgage refinancing, the reverse provisioning of a loan loss. So I think the M&A challenge really is normalizing earnings, what we're seeing in 2021. The rest of this stuff is then really going to just go by state. We've got most of the states covered in our geographic region, except I think we skipped Montana and Idaho this year Montana and Oregon this year for whatever reason, but it's more for our participants today to be able to drill down a little further on. So I think with that, the idea here is that we would open it up to our panel just to kind of discuss what we are seeing, what they are seeing in their regions. John, you want to throw it back to our panel and get this baby going?
Yeah, thank you, Dana. Yes, we're going to have more of a roundtable discussion with all our panelists. So At this time, I'd like to invite Howard to start off with what he's seen in the Des Moines region or anything he's seen that he's worked on this summer regarding pricing and activity. And then we'll lead right into Paul and Karen. So Howard, I'll hand it off to you. I think, Howard, you might be on mute.
That's the story of my life, on mute.
Thank you, Howard.
Well, it's been a fascinating set of years here, and I attribute it to kind of a donut hole concept, and that is in early 2020, we had various deals pending. COVID hits, and it's not so much that there weren't sellers out there, there weren't buyers, because they were insecure about where are we going here, what's banking going to look like, will it be changing dramatically? And it was dormant for a period of about 6 to 9 months. And then now all of a sudden, we're at the other end of the circle, and we're seeing quite a bit of activity. In fact, that chart that you had up for Iowa, given what I know, not just about deals we're involved in, but deals we know of, that will double. I think there's 4 or 5 that will be announced here or have been announced in the last 6 weeks. So, and from everything I understand. So the activity is definitely picking up. Same is true with pricing. The pricing it may be an average of whatever it was. I think it was 155 that I caught nationally. But it's a bell curve without the middle of the bell. We've got deals that are very, very low, and we've got deals that are relatively high that bring that concentric average. And you always have to be careful of averages and medians because it can be deceiving. And why is that difference? I use this expression that I think bankers are ticked off. What do I mean by that? Teed off. What do I mean by that? The focus anymore is on talent, time, technology, and territory. Those 4 elements. Talent is short everywhere. So a lot of the deals that price better actually have better talent on hand. Time, the sellers are running out of time. The clock is ticking on the boomers. Technology, there's some concern about their own internal technology, the cost of data processing, and the externality of that is the technology from Fintech and those groups, which we'll talk about later. And then finally, territory. You do see some restructuring, I think, afoot on branches. And a lot of that will be the larger banks. The larger banks, in fact, are going to drive this. The problem with the larger banks is they're very envious of their territory. They may close their facility, but they may not offer the bank for sale. So you have to be patient. So, and we've actually seen a deal where a larger bank closed the facility in a small rural Iowa town. And within weeks, there were 2 banks that came into that town of less than 500. Does that make sense? I don't know, but that's what's happening out there. So I think, if I were to summarize what their impact is over the last 20 to 21, that would be it.
Thank you, Howard. Paul, can we hear from you? What's happened down in Oklahoma in the last year?
Yes, well, a whole lot, besides the Sooners losing last Saturday. The situation is very similar to what we've heard from our other panelists. And I think my first observation is that, the price situation is very much increasing in the last 6 months. And it seems like there's no end to that at this point that we're seeing. It's prices are continuing to bid up. And that's when I say bid, it doesn't just mean, transactions where they're putting it out for bid, but it means in all transactions that we're seeing the price is up. And by up, I would say that 1.54 book is in the range and low for what we're seeing currently. And we have a little lower than that and somewhat above that and pressing upwards. So that's the situation. Definitely an uptick in overall activity, as I said. And we have just in our little small firm, we're a small firm on purpose. We're a very committed community bank firm, small banks. And we have so many transactions that we're closing right now, pretty much 1 every month these last 3 months, 5 in the last 6 months. We have 4 in the pipeline and 3 in the queue behind that. So, and others that are talking. And these are all cash deals or no stock deals, all cash deals. And as I say, with the price going up. So, you know, the strategy that is involved in this, I don't really fully understand, other than the fact that it seems to be a combination of sellers that really want out, buyers that have been looking and couldn't find a deal and now have finally found the deal and they're willing to pull the trigger and they're willing to pay a little more. And I think I really liked Howard's 4 T's. And I think that the territory is one of the big issues in Oklahoma, because those rural deposits are typically very stable deposits, at least they have been, and seem to be holding that at least to this point. And so those are very desirable. And the idea that urban banks are worth more than rural banks, we're seeing turned a little bit on its head in Oklahoma, as some of the rural bank deals are actually exceeding the prices of the urban bank deals. So very interesting in Oklahoma. That's the state of things now.
Thank you, Paul. Karen?
Well, thank you. And thank you for putting the panel together again this year. I can't believe it's year 41. I won't say how many of those years I attended, that give away age, but congratulations to Eide Bailly on 41 years. Well, my story, I guess, is very similar to what Howard and Paul conveyed. You know, Minnesota, Wisconsin, Iowa, Illinois, great number of charters remaining, even though the number of banks has significantly decreased in the country. We still have a lot of charters. And as a result, you know, M&A activity continues to be fairly strong. This year, there was considerable pressure, I think primarily from the accountants, worried about year-end tax changes. So a lot of deals, I think, got pushed through, signed this year. And as Paul said, we similarly at Fredrikson have got more bank deals closing this quarter than we've had, I think, ever. So we are extremely busy. You know, pricing has continued to be strong. One big change, and we heard about this from the prior speaker and also Dana's comments, was the fact that bank balance sheets have ballooned. We've got, it's hard to say, and it's just incredible, but we have too much liquidity. I didn't think I would ever say that in banking, but it's certainly the case now. And so we're not seeing bids coming in based on formulas. It's fixed premiums, which is something had not seen for a while. The other thing, I've worked on a couple of deals now, and I'm working on yet a new one that just came in within the last couple of weeks, where community bank, not publicly traded, looking at a cash and stock deal. Again, don't see much of that, but I'm starting to see a number of community banks wanting to push a transaction which is at least partially stock, and they have different reasons for it. The one deal I worked, it's because just the numbers, they couldn't come up with enough cash. Other deals, though, that wasn't the issue. They wanted people in that community to still own a piece of that bank. So I don't know if we're going to see more of that, but it's a start of a trend, at least in my part of the country. You know, the pandemic clearly delayed transactions, but I didn't see it really derailing that many. And I agree with the comments made about what we're going to see, at least in first quarter. You know, that nationally, I think there was 16 new deals announced since the beginning of October. And I've had 6 new deals just come in. So the pipeline seems to be pretty full.
Thank you, Karen. I will just reiterate, I think because of the volatility in these balance sheets, we are seeing almost universally fixed premiums going forward. And I think that's fair for the sellers and the buyers to take some of that unknown out instead of a book value multiple. I think our buyers are starting at that point with their price to earnings ratios and then converting it to a book value multiple, but then the final analysis put it in a fixed premium. So we take that volatility out of any surprise in the balance sheet when we get to closing. Also, I liked Howard's analysis. We have a bell-shaped curve with no middle of the bell. I think in Minnesota, we've seen that same thing. We've seen some really high premiums, and yet we've seen some deals that maybe just they certainly didn't get to that average. That may continue, I don't know, but that's certainly what we seem to be experiencing in Minnesota as well. With that, we're going to move into our first topic. And regarding the M&A process, our presentation today is walking us through the presentation process. So what we're going to talk about here is early on in the process, what are some of the things our buyers and sellers need to be aware of relatively early in the negotiation? We will start with Karen, but also then we'll hear from Dana and Howard on anything they have seen regarding maybe something new because of the pandemic or something buyers and sellers need to be aware of early in the process. So I'll start with Howard. Oh, excuse me, Karen. My fault. Karen, thank you.
That was a trick, Howard. See if we were paying attention, right? Well, I think a key decision, and this isn't something new, John, but certainly still up for debate, is whether to go through the auction process or do a negotiated deal. And the benefits of negotiated are speed and confidentiality. And with a bid, you're getting fair price, maximizing value. So that is still something that I think bank groups who are considering a sale need to fully appreciate and understand what those options are and the pros and cons. With respect to due diligence, one thing that has been hammered on and it hasn't changed, and that is the importance of looking at vendor and employee contracts. I think too many times that isn't looked at early enough in the process, and it can really crash a deal. I would say the termination fees, conversion, deconversion fees have gotten even higher and more difficult to determine, and pretty critical piece of any deal. Competitive issues. I have now had quite a string of transactions where we've run into competitive issues in certain markets. And we're going to see more of that. And I think we're going to see more of it for a couple of reasons, just with the amount of consolidation. It's logical. You're going to have more concentration. And then, the political landscape has certainly changed and shifted. And I guess my message on that to both buyers and sellers is look at those numbers early. And if you do exceed those HHI, don't give up. I mean, those are benchmarks, and there are a lot of pretty valid arguments and analysis that can be done to still get the deal done. I love the comment about the workerless economy. Third on my list is lock up employees. In the current environment, turnover is really high, and finding replacements is difficult. I think in deals, employees are going to be pretty high value, pretty important piece of the deal. Look at deal structure. We used to be able to schedule that core conversion in a matter of months. No longer. I, in fact, had one deal recently where the core processor said the time frame will be somewhere between 12 and 15 months. So as a buyer, I've got a number of clients that are comfortable. They will do a legal day merge and then many months later, do the core conversion. But that's very detailed. Lots of considerations, and you need to carefully, develop a game plan to successfully do that type of integration. And then finally, I guess on due diligence, look for those obvious regulatory issues early on. I think given the regulatory climate we're in, I think we've been lulled into thinking, hey, everything's good. The balance sheets are good. We got tons of capital. Everybody's rated satisfactory on CRA. No problems. Well, I think we are going to see more regulatory issues raised as we're going through the application process.
Dana, do you want to add your thoughts at this time?
Yeah, lots of thoughts. I think we're already seeing it with the due diligence, and I think Don mentioned this too, the fear of loan quality, not just in the target shop, but the buyer's shop. We've had some regulatory feedback on other applications already to that extent. So due diligence in my world always starts with having a clear picture of loan quality. And with that, I've heard some discussion also that we're back to the days of some of the loans being left behind. So having those discussions with sellers right away is very important, because that could be a complete deal killer for some of these sellers. And I think of what was talked about structure-wise. I think the environment we're in right now has swung the pendulum a little bit to the seller controlling how the structure is going to be. And, I think of typically big picture, you can do a bank merger, forward cash merger, pretty straightforward. Or you can have a separate charter, a 3A3 Federal Reserve application process. This is, again, kind of what I'm seeing is sellers know their buyers out there. So if it works better one way or another for them, they're kind of carrying the terms back to the buyers on it. Karen mentioned it. Obviously, when you're doing due diligence, you got to have communication right away, buyers and sellers, with the transaction costs, who's going to pay termination fees, core processors, investment banking fees, attorney fees, accountant fees, all that stuff. I think the buyers that I'm working with, the struggle we have is really normalizing the earnings stream. But sometimes it just kind of gets considered, but knowing the competitive market that we're in, it seems like we're stretching the earnings capabilities of a target when we're seeing the bids coming in. And along those lines, I indicated 2021 was really characterized nationally by large bank deals, but it's been pretty surprising in our market area that some really small banks, I think that the days of the negotiated with the neighbor deal might be over. Sellers are pretty comfortable going to some type of an auction process to it, because they just never know strategically who's going to waive a bid that they didn't even think would be a potential buyer. So that's been kind of a surprise, as we've seen the geographic footprint, maybe with technology being a larger reach, and you start seeing some smaller banks, and I'm saying under 500 million as a smaller bank that recognizes the need to achieve some of these scales. We're having some buyers that we've never thought were buyers before come to the table with some pretty surprising bids. So I think that's probably, the upfront analysis that we've kind of gone through in the last year.
Thank you, Dana. Howard?
Yeah, John, it's hard to be cleanup hitter when everybody ahead of you hits a home run. So
I always bat third, Howard. I always bat third.
So what I just want to hit some points here. data processing, Karen is exactly right. It's a black box anymore. There's no other way to put it. It's a black box in terms of time commitment. It's a black box. And if somebody can figure out the pricing of some of these termination and conversion fees, God bless you, because I don't know what it coordinates to. And I sometimes think, the thing that Karen heard about 1 year delay or something, or I think what they're telling us is they have an employment gap. They don't have enough people. That's really what's going on there. It's the same talent issue that we started off with, Don, and it's continuing a theme throughout here. A second thing is that, I think in terms of due diligence, one of the concerns that, one has to have, it relates to what Dana said, and that is we are starting to see people look at loans, even though the banks are in this, quote, terrific shape that the buyer does not want, and or there are special actual agreements relating to those. A third issue relates to what I would call the cyber concern, out there that, people need to do their own homework about how clean they are in cyber, because that's going to become an anxiety as we move along here, particularly if we have an incident or two. And the logical target is not necessarily JP Morgan. It could be some little bank out here, because you prove the same point that the system is vulnerable. So those create anxieties in the due diligence. In terms of employees, how do you do a deal where you've got a target, and at the same time we've got markets in part of the state where it's almost a bounty for loan officers. I can't grow the bank internally, so I've got to grow it through relationships. Well, those relationships come from the people you're hiring, so you've got to kind of be concerned about, how loyal are those employees? Are they going to stick with you? How do you preserve that continuity or stickiness to your institution? So I think those are all issues that one confronts in terms of auction versus one-on-one. Auctions were very, very prevalent till the 2020, and then suddenly we went into kind of these one-on-ones simply because there wasn't the feeling that this is a time I want to auction it with multiple people. And I think as Karen and Dana both said, the auctions do produce fair value. Part of that, when you look at a deal, you have to think, if you've got one or two owners, the stress on auctioning is a lot less than if you have 100 shareholders and somebody's looking over your shoulder. So those all create kind of decision-making processes that occur. And then finally, relating to the vendor process, if you're going to be on the sell side, make sure that you understand what your vendor relationships are. And even if you're thinking about 5 years down the road of selling, look at those data processing contracts, because they're all sort of, it's just pay me the rest of the rent kind of through the end of the term. I mean, it's why that hasn't been challenged, I'm not sure, but it is out there. So you need to do planning, not just on the acquisition side, but on the sell side as well. And the final point with that is obviously, and this is kind of a promo for our hosts here, Eide Bailly, you've got to talk to people earlier rather than later. It's when you're against the wall that your decision making is limited. So due diligence is planning ahead, farther ahead the better. Thank you.
Thank you, Howard. Yeah, I think I'll just reiterate on the buy side, these core conversions are scheduled so far out. I think if you're in a negotiation, we've seen just 2 deals in the last 3-4 months where they've decided to keep the charter for up to 6 to 8 months because they cannot do the core conversion and they don't want to delay the deal. From a tax perspective, there was some pressure maybe from some tax accountants to get the deal done in 2021. So we moved the transaction along, and now they're going to run 2 banks or this additional bank for a period of time until they can get it converted. So we are seeing quite a bit of that.
Let me just add something to that real quick, John.
Yeah.
We have done deals that are still mergers without merging the core processors. So for our audience, what's involved there is really you have branch accounting, but branch accounting is being done by 2 different core processors. So the challenge is just think of the financial statements, think of the call reports, think of the tax returns of taking two separate books, so to speak, to merge them together for the consolidated reports that are necessary. It can be done, but it definitely adds to the ongoing accounting end of it, probably more than anything. So with that, there's going to be a price that is associated with that additional time. It can be done. It can be painful, but it can be done.
With that, we'll go into our next topic. And Paul, you and I worked on a deal here last year that had some really unique indemnification terms in the stock purchase agreement. And I'm going to ask the panel of attorneys to expand on anything they have seen in the last year, specifically into purchase and merger agreements that might be due to the new environment we are in. This could be indemnification terms, reps and warranties, termination clauses, anything you guys have seen out there maybe. Paul, we'll start with you, and then we'll go with Karen and Howard to follow. Paul?
Sure. Thank you, John. Yes, it's a very interesting one. And before I move into talking about that one specifically, just to reiterate, not that it's necessary, but the vendor contract situation that Karen talked about is becoming a bigger deal, and the core data processing, IT, we're seeing IT contracts that are 7 years. I had a client call me last year near the end of the year, meaning I think it was the 30th of December, wanting me to look at the president of the bank had ordered the operations head that they needed to have this their data processing contract renewed before the end of the year because of a price deal. And so she was getting ready to sign a 15-year core data processing contract, which wasn't even actually mentioned to me. That was part of what I needed to look at. So, you know what those contracts are like. We didn't get very far into that one before I'd blown the whistle. But the point is there's all kinds of things out there that are just really kind of unbelievable. Howard's exactly right. What everyone says is exactly right. There has to be planning up front. And for those of you who aren't even planning on buying or selling, you need to be watching those contract terms and the price that's being, the deal that you think you're getting isn't necessarily the deal that you want. So moving along from that, one of the deals that we did this last year that we had the privilege to get to work on with John and Eide Bailly was a transaction in which, and we used to have a lot of these back in the days, in the old Oklahoma, Texas days, in the 80s and early 90s, when we would have a pile of loans, as was referenced. I can't remember who mentioned that a while ago. That is an issue, and are we going to ask them as a buyer? Are we going to ask the seller to keep those loans? Well, there are different ways of doing that, but in this particular case, what we ended up doing was a little bit of a different kind of an arrangement, to where we had specific loans that were identified, and we could not come to an agreement on what kind of a provision, if there was any provision at all, or just a flat charge off or charge down that needed to happen before we got to closing. And so the sellers were absolutely convinced these are the greatest loans in the history of the world. And I represented the buyer who thought the exact opposite. So it was a lot like a workers' comp claim, and so what we ended up with was a compromise in which we agreed, as the buyer agreed, not to pay them for those loans, for the portions of those loans that we believe should be charged down or provision for. And we also agreed, though, that under certain conditions that had to be met over a certain time period, that they had, if the loans met those conditions over that time period, then we would go ahead and pay them. And we included a shareholder representative that was nominated and voted for by the shareholders of the seller, so that we have somebody that our bank pays in the event that which we haven't had any of these pay off to my knowledge. But anyway, in the event we have to pay, all we have to do is pay that shareholder representative, and the shareholder representative has a responsibility to pay out then to all the shareholders of the seller. And so now the accounting for that is a whole different matter. And if John wants to comment on that, he can. But interesting deal.
I won't comment at this time on that. We'll
understand.
We'll deal with that later.
So one or two other things, and then I'm going to turn it over to our other panelists. But a couple of other points that I wanted to make of items that I've run across this year in terms of legal agreements and what kind of things need to be put into legal agreements. We've seen a lot of dealing with this, with the court out of processor situation and the negotiation of who's going to pay for what. And just as a reminder, the seller is the one that signed that contract. That's their contract, and they're the ones that are obligated for it. But if you're merging the banks or you're acquiring their bank as the buyer, you're going to end up with it anyway. And so it's a very difficult, it can be a very difficult negotiation. And, you know, some sort of compromise is almost always going to be in the works in these kinds of deals, but it needs to be addressed up front, those kinds of deals, because these can be large enough to kill a deal in a smaller bank deal for sure. And so those kinds of provisions in dealing with those, we've actually come to the point where we've had several smaller bank deals recently where what we did was we actually listed out all the vendor contracts and then identified all the vendor contracts that the buyer was going to continue to be responsible for after, and the ones that they weren't. And so that was really the only way we were going to come to any kind of an arrangement between these two particular groups in negotiating this deal. So that's one of the more unique, maybe you all have done that before. I hadn't ever done anything like that before. And we've now had 3 of these that went that way to some degree or another. So kind of a developing deal here. Last thing is the P&A. We're starting to see proposals for purchase and assumptions, and I don't mean branch deals, I mean full bank deals. And that usually has to do with taxes and usually has to do, for example, with a seller that has an NOL or something that they want to preserve. And so it kind of makes sense for them where they can maybe capture some of that for their shareholders and the way the deal works from a tax standpoint. But the cautionary note on that is so that can be a kind of a way to save a deal where you have an S Corp that's buying a C Corp. But the reality of the deal is that, you know, the seller then basically that's a liquidation of a bank, which as far as in Oklahoma, that requires a separate application for the seller to have permission to liquidate the bank, and obviously to go to the FDIC and have to get approval there to liquidate the bank. So there's a lot on the side of the seller when you go with a P&A structure. So I just wanted to note that. I don't know where this has suddenly come from, but we've seen a couple of these recently. So in terms of negotiating your deal and the terms and the agreements that we've seen, the more issues that you can get out front, and I don't mean at the very beginning, but once you've kind of gotten some of the due diligence done and you have a feel for what you're dealing with financially and so on, those matters have to be gotten out on the table and have to be dealt with. Waiting to deal with significant financial issues, that what can become financial issues down the road becomes very difficult and can really doom a deal. So I think with that, I'll turn it back to you.
Thank you, Paul. Karen?
Well, thank you. Yeah, with respect to legal agreements, one thing I'm seeing is a lot of provisions in big bank deals are trickling down. And, you know, even though we're in the best of times compared to the deals that all of us were doing 5-10 years ago, I think in some cases the documents are twice as long. I'm seeing indemnification being extended, or at least buyers trying to extend it so that you'll have your general indemnification article. But in addition, buyers asking for additional indemnification for tax or for environmental. Purchase agreements tend to be spending more time and effort on environmental title. Many more banks tend to be getting phase 1 and phase 2 reports than I've ever seen. And this all raises, you know, both the title and environmental when you're dealing with a 100-year-old bank building raises a few issues, as you might expect. Another thing on termination clauses, and again, this big rush to get deals done in case there might be adverse tax implications, which, you know, there could still be, who knows what's going to come, but have negotiated a few deals where if by the time we get to closing, given there's such a lag in the bank world between signing and close because of the regulatory process, negotiating an out so that if you get to the end at closing and it's no longer a deal that the seller really wants to do because the economics have significantly changed because of the tax world, they can get out for a price. So that's something that was new, just given the current environment with respect to potential taxes. Tail insurance. What I'm seeing is 6 years is getting to be the norm in terms of a tail for D&O. Also seeing cyber. Cyber is a huge risk. Many more reps and warranties with respect to data breach, compliance in that area, and also particular provisions asking for tails on the cyber policy. With respect to problem loans, I too am seeing a lot of deals where there'll be a group of 5-6 loans the buyer just doesn't want. And of course, you either, you know, carve them out, or the other way to get at it is of course special reserves or increase the overall ALLL. The other thing I'm seeing though is on a number of deals where I represent a seller, they've got some potential pretty huge recoveries that might come in, and it's been charged off the books. And I've written in provisions where if those recoveries happen to come in over the next whatever period of time, the seller can benefit. And usually the buyer, you know, is fine. It's already charged off. And so that's just another new twist I've seen more of probably in the last year than in the past.
Karen, when you do that, can you, if you're doing a forward cash merger, can you just have those assets transferred to the holding company? Is that what you do?
Yes,
okay.
That is correct. And then increasingly, you know, and if you want to liquidate that holding company, which we're again trying to liquidate holding companies, I've done more setting up LLCs to hold any of those longer term assets. Okay.
Are some of the indemnification, or you mentioned indemnification periods are higher and maybe the amounts are higher as well. Do we see more escrows?
I have not seen an increase in escrows.
Okay.
And I think for a lot of community bank deals, you know, there's a cost to that, but also, you know, if you've got a rep or some assurance that, you know, the net worth is going to be there, plus by law, you can't liquidate, you know, the holding company if you've got any outstanding indemnification obligations. So have not seen much in terms of additional escrows.
Okay, thank you. Howard, I got you batting third again inadvertently, so let you take another swing at it.
I'll just, it's amazing to me how, you know, different locations similar activity. You know, it's like a lot of things in life, it seems to parallel one another. And have we seen what has been talked about by both Paul and Karen? Yes. In fact, we had in very, very good times a special loan reserve, you know, that's attendant with the escrow period and is parallel to the escrow for the indemnification. It identifies specific loans, and you know, you have a little more flexibility with some of the S corps too in terms of that parent holding company and what it can do or take, or so that's also advantageous. I agree, and to me it was kind of startling, but in the last 6 months, everybody's picked 6 years for tails on D&O, and I don't know whether the companies have just started offering that or why we went to 6 as opposed to 5 or 10, or and a lot of them have pre-existing quotes in those terms. Cyber insurance, yeah, again, last 18 months, people are starting to look at cyber insurance. The problem is with all of these events, the coverage, God bless the insurance companies, gets narrower and narrower, and it might cover you on a Tuesday if it rains and the moon is full, and plus, by the way, your limits are $100,000. But you get what you can, and that's in everybody's interest. That's not on one side or the other. It's just good to have that coverage and then maybe detail with those problems. One of the big concerns with cyber, frankly, is, in incidents that we see down here, involving particularly, I think this occurred in Minnesota and Oklahoma as well, in an unrelated industry in real estate, the penetration of those computers was 6 months before the event occurred. They were parked waiting for the real estate transaction to close. And that is another kind of thing that's always kind of concerned me, but we're little fish in a huge pond. You have seen now where you've got to be very, very cautious with wire information, which is, apparently there was one event in the country where the wire was misdirected involving a bank closing. I'm not familiar with the details, but that makes you stay up at night, So a hint to everybody, if somebody changes the wire on any closing within 24 hours of closing, be very suspect, period. And that was true in the real estate, and that was the modus operandi. So those are all issues. In terms of fees for terminating the contract, never saw those till the last couple of years. And now we're having, some would call it a breakup fee, but it's still very rare. Bankers tend to be still on the honor roll, and the probability once you sign an agreement of a deal closing is so high that it really hasn't come up as much, in part because it's a highly regulated industry, and one way or the other it gets it done. And in terms of any other issues out there, I think what I would say is that the indemnifications are very typical. We see a lot of escrows down here simply because it's a way of sort of maybe even capping the indemnification in most cases with the escrow. And two, it frankly defers some of the money to another year, which now whether that's wise in today's environment. We had this crushed for everybody, as Karen and Paul both said, year end, and now all of a sudden we've got people saying, I'm not sure we want to close, because we think that given all the political results that have occurred in the last 30 days and what statements are made by various senators, that these taxes will not occur. They're just rolling the dice, and you got to roll with them. So that's it.
Okay, thank you, Howard. Yeah, we've seen or we've discussed, the early things to be aware of early in the process. Now we talked about the agreements themselves. Now we're going to jump into the actual regulatory application process. And we'll start with Dana, but I'll ask each of the panelists if they have a unique example of something they've seen this year, either in regards to the pandemic or the regulatory staff we know has been working remotely. If we've seen anything different this year in the application process itself that may warrant comment. So Dana, I'll start with you, and then Howard, will come back to you. I won't have you last this time.
Yeah, before I jump into the regulatory process, you got to give me a moment to address our esteemed panelists here on some of the legal agreement issues, right? You guys are way too close to this situation to really know what the issue is here. I think Karen started it, so I'm not being the hostile host here, but the length of these agreements, incredible, absolutely incredible. The other thing that is more recent, we started seeing it, so it's not really a pandemic deal, but as we've had more small banks move towards an auction process, having the seller draft a purchase agreement, which has always struck me as a little bit strange that the seller's drafting a purchase agreement. So that's something we're having to address more now than I have in the past. Just the laundry list of things you guys identified that have added length to these agreements with the termination provisions operating covenants, which getting into the regulatory side, have some control issues going with it, non-competes, indemnifications, tail insurance, escrow deposits, the tax treatment. So this is relatively new too. Some of the agreements that I've looked at, that it's getting pretty creative on the seller side with how they want to do the 1060 allocations in an asset transaction. So a buyer has to look at that pretty closely. And I think we've had some arguments within our group even about how you can identify one thing in a contract and another thing comes out as the fair value allocations, and how we're going to be treating one for book purposes and another for tax purposes. So things of that nature that have to be looked at. And finally, this is a brand new one for me, and it came from the Federal Reserve actually, that the language in the purchase agreement preserving the allowance for loan loss levels, and some feedback there from the Federal Reserve attorneys about being worried about gap treatment. And if you think this thing through, we're putting a floor on what the buyer wants the loan loss reserve to be at. And the only way you could have a gap concern with a floor would mean they're taking reverse provisions, right? So are we going to have to look at, well, if we're going to protect it in a purchase agreement, we have to follow gap. Does that mean we're going to have a purchase price adjustment in the rare event that something like that would happen? So that's a relatively new one for me. That's probably jumping right into the regulatory application process. You know, you read all the national news about deals taking a lot longer. I think I've been pretty fortunate that most of the transactions I've been involved with have still been acted on under delegated authority. So I haven't ran into the lengthening time horizons that would happen if it got moved out to Washington. I got to be honest with you. I think the approval process has been fair. You know, I think probably going back to the due diligence just a little bit, one of the things I would advise any buyer going into the application is that you're going to want to run some stressed financial forecasts and be prepared to maybe provide the results of that to the approving regulator. You know, it's one thing to have an application that's got one set of realistic assumptions you think as the projection base, but I think you have to tweak that a little bit before you even get into the application to make sure you've got adequate capital levels, earnings power to service debt, any distributions that are necessary for tax liability and things of that nature, that you want to make sure you've got a little bit of cushion if the analysts are looking at it a little bit differently. Other than that, I mentioned the control provisions of the legal agreements seem to always be discussed with the regulators, where they don't want the buyer exerting undue control before the transaction happens. So it usually just goes back to the attorneys to figure out what language we need to appease the regulators. And probably the final.
But Dana, I'll just interject there. We just recently had a pretty heavy pushback from the Federal Reserve on that ALL minimum, that they deemed, while they agreed we weren't exercising control of the acquisition, they were concerned that it potentially could, and we had to make some very specific commitments that while there is a minimum reserve, that we would allow them to continue to operate under GAAP and not exercise early control. I thought it was a more push than we've seen in the past, because those agreements have been in place with those minimums for a long time, and we hadn't seen that kind of pushback.
Right. So the other things that I think about within the last 12 months, if you've got any, I think we talked about that last year with this panel too, if you've got any outstanding regulatory issues, it's as a buyer, that the buyers probably don't think is really an issue. And I'm thinking of shareholder agreements and maybe certain trust agreements as shareholders of the buyer. You've got to make sure you've got those addressed probably before you get into the application phase, because that can really delay a deal if the regulators want more information on something they probably haven't seen before. So just an awareness of that. And probably the last one would be, you started seeing this with some of the larger bank deals too, retention of a target name, even though you might have a merger going on, you know, a DBA. Now you start getting into more state specific laws on how you go about protecting a name. So that's probably been something relatively new.
Okay, thanks, Dana. Howard, do you have any examples of anything you've seen this year in the application process?
Yeah, a couple of, it's not all related to one event, but it's primarily related to one well-known regulator. And that is that on the control features that Dana mentioned, you can file the same document 3 times and get 3 different positions on what provisions constitute control. And a lot of it has to do with whoever's examining it, you know, in that agency, to be blunt. I'm convinced of that. You know, and once that regulatory authority deemed buy-sell agreements to be holding companies, I knew they were focused on control a long time ago. You know, so that's number one. Number two, we were asked twice, and the Fed still maintains its COVID questionnaire, which is just amazing in Iowa, because we were asked for 2 rural targets. And we said, well, COVID's been a blessing out here in reality, because every agricultural entity that is in farming, for example, got $150 an acre from the federal government. So everybody we know is in much better shape, let alone where the commodity prices are now. So that whole COVID questionnaire is just beyond me at the moment, you know, and it really focuses on risk to the system. And you can't infuse this kind of money and argue that there's more risk, you know. So I think that's a point. The third thing is, I think Dana's right. Everybody's trying to move these along, but we had we'll get into this again tangentially in another segment, but we had a fintech buyer, an individual who was very, very successful with WizKid fintech idea in a different state. He saw small market banks out here and a way to get into banking. That took 14 months of review, 14 months to get approved with our friends in Chicago. And that wasn't necessarily the Fed's fault, but it was, you know, they're very concerned about where are we going here? What are you doing? Don't get ahead of our skis, let alone your skis, in terms of what we'll permit or won't permit. And, you know, the tip there is for those people, start off a little humble before you try to revolutionize the industry. You know, so those are things that are, I think, unique to the regulatory world. And again, we'll get into a little more later, but the whole fintech thing has got them just really tensed up about where are we going with all of this, in part because they lack direction from on high.
Thank you, Howard. Karen?
Well, I agree with all the comments from Dana and Howard. I think, Dana, I agree that from my vantage point, the regulatory approvals have gone very quickly if it's a bank acquiring and they don't intend to change the business plan, or there's not a fear by the regulators that the business plan is going to change. I agree that control, any applications going to the Fed, you're always going to get comments back on the covenants and the control. My view is banks are to do their due diligence and mitigate risk. One way you mitigate risk is to have a good contract that has those kinds of covenants and controls. And, you know, they're in there to protect the buyer. And Mr. Regulator, if you want it out, you're creating risk. That's my personal view of that. I think, you know, again, it's not consistent. I do see variations deal to deal on that. And, you know, with respect to the control issue that Dana raised, I agree. If you've got a structure that's going to result in any control type issues, which you can have in these deals we've talked about, where you've got a cash and stock merger and you've got new shareholders coming in. Those change in control issues can certainly delay the process. And I've had a couple where I've had to push pretty hard to get those two processes decoupled, saying, you know, the change, and you should approve the deal and separately deal with these change in control issues given the timeframes.
Thanks, Karen. Paul, anything regarding applications?
Yeah, just a little bit. And appreciate Howard showing me how to back clean up. Thank you very much. So the pandemic COVID questions, Howard, I'm 100% with you on that. I've had all that. It's ridiculous. You know, we had to provide some kind of an explanation here recently, and you know, it was tempting to put in the act to just say our explanation is we're Oklahoma, you know, period. We don't do things the way everybody else does. We don't do things the way, you know, New York or Minnesota or whoever does things. We're Oklahoma and we do things differently. And so we did the 2 weeks to flatten the curve, and then we were done with it. And that was pretty much it. So that was, but they keep asking it, and I think they're going to keep asking it. It's hard to get those things out of there. One other, at least they've gone easy on the responses. One other thing is that that I've noticed, and I don't know if this is in particular just the Federal Reserve that we deal with, which tends to be Kansas City or Dallas, but the due diligence expectations and the detail of description of due diligence has increased quite a bit, I've noticed. And in terms of what the regulators are requiring, and like I said, this is primarily the Fed, although I've had a little bit of it from the other regulators, but it seems like that they're wanting to see a broader touch on due diligence, as was mentioned earlier by our panelists. And then also they're wanting to see a little more in-depth discussion about what was done, what was found, what kind of issues there are, what you're going to do about it. And then the last thing I wanted to note is that the competitive antitrust, I ran across something that I hadn't had happen before. What we typically would run across in Oklahoma is that if we had an area that was undefined in the antitrust competitive area, what would tend to happen is they would tend to look at the county and say where it was happening and where the target was, and say, okay, we're going to define that as the market, and you know, off you go. We're new entering that market, so we have no problems with that. Given what the circumstances of this deal were, but that's no longer acceptable. Apparently, nobody's doing that anymore. And I don't know if it's just that I'm old, or because I mean, I hadn't had this come up. I hadn't had an undefined market in a while, but it hadn't been forever. And so that was one. So what I'm saying is Karen's point about get on that early is a good idea, because you don't want to find yourself at the point of the application and finding out you got an undefined market for competitive purposes. So that's all I've got.
Thank you. Our last topic is a little more open-ended. I think I called it non-bank considerations, but it's really just to see if there's anything else out there we want to touch base on. I think, Howard, you mentioned fintechs already, so I'm going to toss it back to you if you want to follow up on that topic and that discussion. And then we'll go back to Paul and Karen to see if they've got any other just general comments they want to finish up with before we go into the 2022 predictions. So we've got 2 topics left. Howard, back to you.
Well, the fintech area is one that, you know, everybody reads about, has a lot of sizzle and all that, and is very attractive. In reality, what fintechs are doing, and I guess our first speaker even mentioned some new deals out there, but they're searching for, you know, the FDIC insurance, to be blunt, insured deposits. That's what they're searching for. And as a result, they're trying to figure out ways to get into banking. And one way is, if you're wealthy enough, you just go buy a bank. But then, as Karen pointed out, the antennas go way up about, what are you doing here? And one of the issues, frankly, with the fintech industry is you go from the very creative, don't regulate me in New Hampshire or in Iowa, don't tread on me, to the banking industry, which is tied down every way you can conceive of. And the cultural clash there that you face initially is going to be fascinating. We've got a couple fintech groups that want to kind of affiliate with banks. That doesn't just mean merger. It's a little bit off topic, but the same thing. Well, why don't you create a subsidiary and we'll start there and work our way up, which is kind of a creative way of looking at it. And you're also seeing some banks, and this ties into even processing, investing in subsidiaries, in a very limited basis. They're not control at all, but that are, InsurTech or something like that. So I think this whole area is right. We, on a visit we had with the OCC a month ago about an idea where a fintech group was approaching a bank. The OCC's first visit had 13 people on the call. 13 people. One, they were trying to learn what was going on. Two, it was every part of the OCC you could imagine in DC, trying to figure out what's happening out there in Iowa. And three, you get to the end of this and they basically say, we need direction from on high. In other words, as to what we're going to allow, what we're not going to allow. And as you probably all collectively know, in the next few months, there'll be some probable release by the Fed, the FDIC, and the OCC saying, here are some rules of the road. And if you mention the word cyber currency, you might as well hit the alarm button, because they just go crazy about, I think what they really realize is they kind of missed the boat on regulating this. And it's sort of the genie's out of the bottle, and how do we contain this? But the argument that you make is, isn't it better in the tent than outside of the tent in the regulated industry? And I think that's starting to take hold. So I see the fintech area as one that is, and for years, the banks said fintechs are our enemies. I think that position is changing. They realize that we can work together, number one, and number two, even if we have this relationship, it doesn't always have to be a merger and acquisition. And three, they're starting to hint that they're going to go after the cores, that they're really going to try to do what the economic term is, disintermediate the cores. In other words, do the same thing that people have tried to do with banking, come at it from different positions. And, that is something you got to be very careful of, because, you see fintech contracts from some of these startups and they're 2 pages. Well, they just started. That's too high a risk for most banks. It's not the 100-page document that Dana was moaning about, but so these are all non-traditional, endeavors that are inevitable in a technological society. So there.
Have you seen more activity with credit unions, or is that plateaued off?
Well, I was historically been at war, to be blunt. Okay. We're working on changing the Iowa banking code. And in part, it's been delayed due to that conflict between credit unions and banks. And it's frankly a little uncertain what banks can or cannot do in Iowa. Clearly a P&A is the way around it, but there are elements in Iowa, very strong elements that say, if this occurs, we may take them on. So the credit unions are very, very able competitors. And the two arguments that the banking industry raises are the ones everybody's heard, taxes and, differences in regulations. So the two are not as copacetic as they are in many states. So credit unions, we've got a Green State here, terrific, big credit unions. They bought a bank in suburban Chicago and suburban Omaha, here recently through P&A. So we have no boundaries for, that's the other irony of Iowa for credit unions. There's no field that you need common. You just need to fog a mirror and you're in the credit union industry. And that crosses the borders too, which is a little bit unusual. So it's very unique in Iowa.
Okay. Paul, anything you want to add?
Yeah, just briefly, first of all, we talked about in terms of the non-bank considerations, the core processing issues. We've already talked about, the core data processors, but also I brought up earlier and just wanted to reiterate the fact that the IT contracts are becoming an issue as they get to be more expensive and longer terms and very sophisticated, similar to the way core data processing contracts became. From that, then talking about the fintech, there's been a long line of those that I've heard from, many of them with more money than sense, thinking that they want to get into banking, trying to find a way to get into banking. They contact some regulator that they know or whatever, who tells them, well, these are the lawyers that we run across or whatever. And so I end up getting a call from them. We sent every one of them packing. We do, however, have a deal that we're currently working on with a bank, going to do a subsidiary and see if there's something that we can get done through this subsidiary. This is not going to be some major fintech deal, but it may be a little bit of a camel's nose under the tent kind of situation. We'll see, but that's on tap. And I had an email from somebody on that just right before we started this session today. So it's moving and about to move into a regulatory application process. So last thing, credit unions. Tinker Credit Union is a sizable $4.2 billion credit union for Tinker Air Force Base and the rest of the world. In Oklahoma, Tinker Air Force Base is where the AWACS airplanes are all serviced out of and where their home is. And that credit union bought a suburban bank that actually we chartered. This firm had back in 2006 or 7. That was very successful and had a very strong mortgage lending operation and so on. And Tinker Credit Union came in and bought that here not very long ago. So we've had the visit of that in Oklahoma, and there's talk of more of it. The last thing I wanted to mention on this is marijuana banking. And could we go without hearing marijuana banking? Is it possible? The point I wanted to make is relating back to, because this is another industry issue. And, my concern is in these M&A transactions we have many banks in Oklahoma that did not want to be marijuana banking banks. They've elected not to be marijuana banking banks. And in an acquisition deal, it's one of the first questions that you want to find out is this target a marijuana banking bank? Because if it is, then you're going to have to get your BSA program up to speed and get it up to speed quickly, and probably bring in their BSA person and probably bring in a consultant to help you with this. So it's a very important sort of other industry that affects these transactions. And so I just wanted to point that out, and that's all I've got.
Karen?
Quickly, because I know we're getting close to the end here. But in Minnesota, there's still are a number of smaller charters. And certainly if you're a fintech, is between starting from scratch or picking up an existing charter. It's pretty easy to advise, pick up an existing national charter. And recently worked with Eide Bailly on such a transaction. And for some banks, it can be pretty attractive if you can deal with the deal potentially not happening, because as was discussed earlier, those timeframes can be years, not a few months in terms of deals getting done, and they can fall through. So I guess my advice to sellers is it might be a really good price from a non-bank buyer. And they may more readily keep all of your staff. They may more readily keep vendor contracts, but huge regulatory risks, timings and issues. So be sure to have lots of earnest money that they lose if the deal doesn't get done.
Okay, thank you, Karen. That leads us to our last topic, which is predictions for 2021. At the end here in 2022, we've got 5 minutes left. So I will give 1 minute of predictions to each of the panelists. And I'm going to throw you a curveball here. Dana, you're not going to lead off. Dana's going to bat fourth because Dana will fill whatever time is left. So Paul, Karen, and Howard, why don't you guys take it away with the predictions with Dana to finish?
So you got 30 seconds each. Let's go.
Go.
Okay, here we go. Number one, pricing. Pricing will hold, may get a little stronger, may be affected by economics. Two, the volume of deals. I believe the volume of deals will hold. Looking, for example, in Oklahoma, we still have 106 banks at 250 million or less. I think those banks are prime for being acquired or growing for themselves. So I think the volume of deals is going to hold. That will obviously be affected by extraneous things, taxes, regulatory, economic, and so on. And I think that the other is that as a wild card is regulatory issues due to the policy focus of our administration, emphasized, I think, by Don in his talk about the current nominee for comptroller. That's all I have.
Paul.
Well, Paul, you wrote my script. I had pricing stable to up, volume of deals stable. Other regulatory political landscape has shifted. We've got CRA redlining and competitive issues.
Thank you. Howard?
Ditto to the two that preceded me. You know, we've survived the last 2 years. We're going to survive the next two. I think people should be maybe a little more optimistic than they are right now, even with it as it relates to the government. Somehow banks find a way to make it through, and they've done it, for 100 years, and we're going to continue that. Prices up, deals up, move on, and keep calm.
Thank you. Dana, why don't you take us home?
Predictions. I'm going to use COVID as a blessing line somewhere along the next year in a regulatory process. Prediction number two, the Atlanta Braves will not repeat. So Braves fans everywhere, enjoy the moment because it's not going to happen, and enjoy the fact that you were surprised by the fact that they're World Series champions. As far as M&A market, you got to believe more deals are going to happen. Pricing pressure is upward. To what extent is really the question. The extent is probably the unknown based on interest rates, right? If we're projecting out budgets for next year, if the Fed doesn't move off of this rate environment without any other influx of government money, bank earnings are going to be down. So to what extent does that slow the upward momentum on pricing is probably the biggest unknown. I think the big banks were in a rush to get deals done this year because of antitrust concerns with the change in the administration. I would say you're going to have more aggressive credit unions just because the same thing. That if we start seeing states prohibiting credit union bank transactions, I would think the aggressive credit unions are going to try to get in sooner and probably wave around pretty large premiums to get that done. I think the other thing, I originally termed it loser premiums, but I think in today's world, I probably have to say participation premiums. And what I mean by that is more and more banks that are getting involved in the auction processes that are not the winning bidders are going to remember that and probably go into the next with even a larger premium, no matter what. So I think that's very positive for the community bank space as far as premiums that might be offered in that realm. And then finally, I think for our community banks, branch deals that have to be looked at. I think our large banks, again, the virtual world, they're going to be looking at closing branches, and if you can get in front of that with a area that you're interested in, making an offer to a larger bank that takes it as an exit strategy, I think that could be a pretty good growth strategy. And I think we're already seeing it, a lot of community banks that are anticipating The biggest challenge is going to be loan demand. So we're seeing more and more loan production offices being open to try to get key talent in place before they might go in a more permanent situation. There you go. Atlanta Braves as champs, Gary.
Thank you. Thank you to all our panelists today. Thank you for taking your time out of your busy days, and thank you for your opinions and your thoughts. I also want to thank all our registered guests today watching today. We at Eide Bailly very, very much appreciate what you as bankers do every day in your communities, hence the name of our seminars this year. We are truly blessed to work with so many wonderful people, and I want to thank our panelists again. So with that, I will hand it back to Gary.
Yeah, thank you, John. Again, as John said, thank you to all of our speakers today. I want to again especially thank Amy DeGeorge and Cheryl Knutson for what they've done. Again, to all of you as bankers and industry professionals, we thank you for your time and attention, and thank you for your support of Eide Bailly. It means a lot. Remember to check out our last virtual Eide Bailly Bank Seminar this Thursday, which will have Doug Duncan, Chief Economist of Fannie Mae, and a tax update on changes and potential changes that we might see coming out of Washington. So please make sure you register. Again, eidebailly.com/Bank Seminar 2021. Make it a great day, and Amy, take us home.
All right, everyone. Well, thank you so much for attending. Thank you to all our presenters and our panelists, and we will see you guys hopefully on Thursday. So thank you. Have a great night, guys.